Howdy, folks, and welcome to the Daily Coin. My name is Rory, and today is Friday, January the 29th, 2016, and I have the great honor and distinct pleasure of welcoming back Mr. Craig Hemke, who is the proud owner and president of tfmetalsreport.com. How you doing today, Craig?
Oh, Rory, the honor and pleasure is all mine. Thank you.
Well, we have a couple of pretty hardcore items on the agenda today, so let's just get started. What do you say?
Sounds good.
All right, hey, Craig, I've got just have two items, and one is the article that I sent you yesterday about the fix going crazy over in London, and the other is the death candle. I want to kind of follow up. I want to keep that in front of people. For obvious reasons. I mean,
Yep, sounds
they're
like a good. It's a good idea. Excuse me, especially with the month end rally just in time to maybe save
just
the
in
S&P
time.
today. Yeah, how about that?
Well, let's start with the fix. If you're comfortable with that, we can talk about the markets for just a second, and then jump right into that, because it seems like that the silver market has kind of recovered from everything yesterday.
Yeah, the fix came in today, below where the futures were trading. Again, second, not nearly as much as yesterday, but significant enough that people noticed. And it's just shines a spotlight on one, how crazy that process is. That those silver trades electronically all around the world for 23 hours a day. That these dudes get together in a room in London, or that's one way to look at it, but all electronically and communicate, and then they declare as if it's 100 years ago what the wholesale price for silver will be for the next 24 hours. And what was so highly unusual about yesterday is it was about 80 cents below
Yes.
where silver was trading. I don't know. Rory, it's been really interesting to watch silver on a daily basis for the last, well, not only the last 5 years, but the last 2 months. I can send you a chart of the daily action in silver over the last 2 months. And almost every single time that price gets above 14 and then manages to move toward 1440, which we've long identified at TFMR as being a critical point of either support or resistance, depending on which way you're going. Anytime I got up there, 8 times at a minimum this last 2 months, price has been viciously smashed back down.
Wow.
And lo and behold, yesterday, where were we when this fix came out at 1365? We were at 1445. And I was just laughing to myself. Now I pulled up one of those Kitco charts that shows the last 3 days.
Yeah.
Where the price, and it goes across in a straight line at 1445, and then it goes across in a straight line at around 1425, and in between there's just this maneuver straight down connecting the two. It's
Nothing wrong there.
No, and again, you don't know what's going on. We watched the area around 14 be what almost seems to be a floor for silver now for the last 14 months. There was a raid on silver on the Sunday night Globex on Sunday, November 30th of 2014. So we're talking 14 months ago.
Wow.
And that night, price got all the way down and tapped 14, and then reversed and shot higher, and left a big, huge reversal candle on the chart. Well, anyway, it's come down there a couple times since, and now really all through December. Every single time that it gets really dramatically shoved back down to that level or below it, it seems to it's an old metaphor, but it's almost like pressing on a spring. Now, that doesn't mean they can't jam it lower, but something funky is going on there. And we've never, I can't ever even remember at any time seeing anything like what we saw yesterday out of the London fix. And a lot of people really took it in the shorts. And you don't know why price was, that wholesale price was set that much lower. When they finally got around to doing it, because it came in about 10 or 15 minutes late,
Okay.
when they finally got around to do it, all of a sudden, a couple minutes thereafter, it was that big price smash that took the futures down all the way to 1405. Spot never got that low. And you don't know if that was a reaction to the fix. You don't know if the fix was held for 15 minutes because they were waiting for that order to come in to justify the fix. I mean, who knows? All I know is it's just a big, gigantic scam. I'm still just astonished on a daily basis that this scheme, this fractional bullion banking scheme, continues here in 2016. But events like yesterday lead you to wonder how much longer it'll go on.
Well, I mean, when you have, criminal entities like HSBC, JP Morgan Chase, and UBS, all three of which, that's three of the six that participate in this price fix, those three have been in a court of law and found to be guilty. HSBC, guilty of drug money laundering, guilty of terrorist funding terrorists. JP Morgan Chase, guilty of fixing the LIBOR. UBS, fixing the LIBOR and the Forex, I believe. I think all three of them were found guilty and fined for rigging the LIBOR and the Forex markets. I mean, when you have that level of criminality, something like the silver market is like, well, that's something they rig before breakfast.
Yeah,
I mean,
yeah, and then they figure nobody gives a damn anyways.
exactly.
Right?
I mean,
So,
it's incredible. But I want to read this because and this is from the article that I'd sent you yesterday, Craig, and I have to give a shout out to Sean over at SGT Report. He and David Morgan. David Morgan's the one that sent him this article, and then they actually did a podcast about it, about what's going on. But I want to share this with you and get your thoughts on it. And this is from the article, Silver Market in Disarray After Benchmark Price Fixed Far Below Spot Rate. And it says the LBM silver price, the crucial daily benchmark used by producers and traders around the world to settle silver products and derivatives contracts, was set at $13.58 per ounce, which we were just discussing, that being about 80 cents below where spot was, or 60 to 80 cents lower. But this is what I really want to get your thoughts on, Craig. And it says, and this is a quote, the LBMA silver price is established through a transparent electronic auction mechanism designed to adjust the price until there is equilibrium between buy and sell orders, end quote. And that's from a CME spokesman. Now, to me, that sounds like an ongoing rig, because why is it looking for equilibrium?
that's a good point. Well,
I mean,
and that's the way they've done it for over 100 years, and it's only been recently that they have tried to make it more, as you say, transparent in that article.
well, that's what they say.
It'll be fun to see if there's any industrious correspondent, reporter, investigative reporter, whatever, goes out and looks into the alleged transparency of yesterday to find out just how and why they were able to discover a wholesale price and fix it for 24 hours that's 80 cents below the ongoing spot and futures price. I don't have an answer, Rory, other than, I mean, I think the truth is buried in what you read earlier, which is, for a day, not only were wholesale buy and sell orders placed, filled at that price, but derivatives were settled at that price too.
Exactly.
Did you catch that part?
I did.
So I'd like to know, they may say, oh, it's all transparent, it's all right here for you to see. I would imagine there was probably some back channel communication going on. That's why the fix came in so late that some type of arrangement was made to allow somebody off the hook with a fix coming in at, like you said, 1358 instead of 1448.
Exactly.
But we'll never know. But again, we'll never know, and nobody will care. Excuse me. It's like, when the day comes that it's finally realized that all of the gold and silver, and even silver too, in the world has been pledged and repledged and hypothecated, rehypothecated, leased and released, and the music stops, and the COMEX futures exchanges, the pit for both gold and silver, they just cash settle everything out and call it a day.
Exactly.
And we'll move to some other platform, and it'll be a big story, for a day.
Maybe a day.
Yeah. And then we'll see where we go from there.
And speaking of which, I mean, China's been making all of this fluff for quite some time now, several months, maybe even a year or more, about putting into place a physical futures market similar to the COMEX. How would that play into all of this? I mean, as far as what you just described, I mean, when do they step up and say enough is enough?
Well, I actually wondered about that yesterday and kicked around a couple thoughts with some of my subscribers on my site, in that the timing of this, because this is unprecedented. We just don't.
Yes.
This has never happened before, which I guess is what unprecedented means. It's Friday, Rory. God, it's been a long week. Anyway, the timing is interesting in that we are finally, apparently, within about 60 days of the Shanghai Gold Exchange publishing their own competing once a day gold fix denominated in yuan. Now, all of a sudden, we get this silver fix issue yesterday, and again, to some degree, continuing today. Isn't there a line in that article that you read earlier that says something like, this really calls into question whether the fix will be able to be continued?
Yes, there is. It says almost exactly that.
Read that line, would you?
Let me locate it here. Yes. Unfortunately, this is a direct quote. Unfortunately, it's not a mistake, from Ole Hansen, head of commodity strategy for Saxo Bank, told Fast Markets, quote, this could be the end of the fix. It took 14 minutes to find a fix. They obviously found a fix way off of the market, end quote.
Okay, this could be the end of the fix. Let's use that as a reference point, though, for a second. Because, again, they've been doing this now for, 150 years or whatever it is, right?
117 years.
Okay. And now, all of a sudden, in 2 months, Chinese are going to offer the world their own competing yuan-denominated fix, right?
Right.
And now, here out of the blue, we get this issue on the silver fix. Hey, maybe my little tinfoil hat's on a little too tight. But in the world of, let's say, all's fair in love and war, right? So in the currency wars, in the global paradigm shift, all that kind of stuff, does it strike you as perhaps an odd coincidence that just as the Chinese are ready to offer an alternative, you get this event yesterday and again today that casts aspersion and doubt as to whether London should continue to offer or be the sole proprietor of the silver fix and, by extension, the gold fix?
It is interesting timing. That's
yeah,
for sure.
It is. It is, isn't it? So we'll see. If anything, for God's sake, people need to look at this and realize that how crooked it is.
Yes.
These, again, all the metal is leased, released, hypothecated, rehypothecated. There are literally hundreds of paper claims, whether they're COMEX contracts, London unallocated accounts, all these unallocated gold pools run by all these other bullion banks. There are literally hundreds of paper claims to every single ounce, not only in gold, but also in silver. And that game continues as long as there's confidence that, well, really, should I demand my metal at any time? My bank can provide it to me. But if that music stops and that confidence fails and everybody shows up at once trying to sit on the same chair, well, we're going to have ourselves some interesting times, Roger.
Yes, we are.
Uh
And
huh.
and
And
I and
we'll
I
see.
want to ask you about that what you just described in light of the fact that the mines are collapsing, they're
Yep.
closing, they're shutting down, they're slowing down, they're not producing. I mean, Steve St. Angelo just reported that there was a 25% drop in one of the largest primary silver mines in the world. Mexico, 2 years in a row, is running about 10% below their production. Australia's way below. I think the only silver producing country that's positive for production is Peru. I think everybody else is way off mark.
Yeah, and,
So
and and look at the numbers for gold
exactly.
from a supply and demand standpoint too. Yeah, we're there's no doubt the I guess we'll call them the official numbers from Thomson Reuters and the Silver Institute show a silver supply deficit each of the last 3 years.
Yep.
But even more, perhaps more significantly, is what we're seeing in gold. The official U.S. and U.K. import-export numbers show gold rapidly leaving both the U.S. and U.K. U.K. obviously doesn't have any gold mines. I mean, they might be able to mine some peat to flavor their scotch, uh, but they don't mine anything else up there. But yet, all of a sudden, there's 30, 40 metric tons leaving London every month,
Every
go,
month.
going into Switzerland, then being re-refined in Switzerland and shipped back out. The monthly import numbers, whether they're from Russia, China, India, all these different countries, you just leaves you scratching your head. Where the hell are they getting this gold?
Yep.
Where's it coming from? How close are we? I mean, to the end, you keep hearing these anecdotal stories about these bullion banks attempting to source metal even at the mines in doré form and shipping it off to the east. Just kind of living hand to mouth, trying to keep the game afloat. I don't know if I don't know if that means we're at the end or whatever, but if that demand goes away, or if that supply goes away and demand continues, we're that much closer to the end, no doubt about it. And I have maintained, I don't know if we've ever talked before about the chart that I follow for everybody every week. I call it the nemesis line, trend line on it. If you go back to April of 2013, almost 3 years ago, we had held the area around 1525 in gold as a floor for 19 months. And then suddenly on April 12th, Friday, and Monday, April 15th, gold was carpet bombed for about $200. Massive amounts of paper thrown at it and smashed. Broke down through that support. We bottomed that night, Monday the 15th, early the 16th at 1320. Rallied back to 1450 and then bottomed down at 1180 in late June of 2013. If you go back to that first little bounce, back to 1400 in May of 2013, and you connect it to the next bounce and then extend that line down, you find what I call our nemesis line. And it is that line that the banks have endeavored to keep price below now for 3 years. You can see every time it breaks back above that line, they all of a sudden they're adding shorts like crazy, and they jam it back down. And the chart has a string of lower highs on it. The key here and why they're doing that, I've long contended, is they have to control price and keep it in a downtrend so as to control sentiment, specifically Western sentiment.
Right.
Because if Western sentiment turns, if Western investment demand suddenly picks up, I mean, where the hell are they going to get 800 metric tons to put back into the GLD? I mean, where's that going to come from if sentiment and demand turns? If Western investment demand, did you see the great presentation put together by Grant Williams? That thing, what do you call it? Nobody cares. Have you seen that yet, Roy?
I have, yes.
Okay, do you remember the part where he showed total Western investment demand for gold, and the size of it was like $500 million. I mean, it was nothing.
Nothing.
And if you just simply tripled that up to 1.5 billion or whatever, you'd pretty well wipe out all the paper gold on the planet. You'd buy most of the major miners. You do all this stuff. I mean, it's just not. Anyway, it just gives you some idea of just how critical it is that these banks keep shoving price down, to keep sentiment down, to keep absolutely no interest in these pet rocks, because they are doing everything they can to meet Eastern demand. And if all of a sudden there's Western demand and the music starts to slow down and eventually stop, the whole thing just explodes and implodes and everything else. And so, gosh, we live in interesting times, Rory.
Yes, we do.
And we're seeing all these things like yesterday's silver fix that just leave you more convinced than ever that we're getting close to the end.
We have to be getting close to the end, because what happened yesterday is an absolute act of desperation.
Yeah,
like
yeah.
like you said, there was somebody that cut a deal, and the word derivatives didn't show up in this article by accident.
Right.
I mean, that was put in there for a reason, and that to me, that reason is those 14 minutes that they were trying to figure out what to do, how to do, and who to do it to. And it took them that long to get everything straight to where it didn't blow up in their face.
Yeah.
Because
Well,
the fuse was obviously lit.
And Rory, this happened in London, didn't happen in New York. So at least we don't have the bumblers and the co-conspirators of the CFTC in charge of this one. Maybe some large entity that feels that they were taken advantage of and screwed, for lack of a better term. Maybe they'll pursue this. Maybe they'll pursue this through some type of judicial process in London, and we'll eventually get to the bottom of what took place. Actually, maybe the whole thing will blow up before we ever have that type of investigation. But yeah, it was, what they did yesterday was outrageous.
Yes.
And it should be looked into. And instead, I'm sure, well, God, who knows about it besides you and I and anybody else that's listening? I mean, you don't see coverage of this on CNBC. There's no big expose in Bloomberg today.
Nope.
Can you imagine? Can you imagine if the closing price of let's see, right now, as I look at my phone on an hour before the close on Friday, I got the S&P at 1928. And all of the mutual funds that are going to be liquidated today, if you put in a sell order for your open-ended mutual fund, you put it in during the course of the day, but you get today's closing price. That's what you're going to get liquidated at, right?
Right.
That's going to be the net asset value of your fund. They're going to liquidate your shares. You're going to get a check for the liquidation. Well, let's just say that instead there's this shady group of folks that behind the scenes, even though the S&P closed at 1928, they decide, let's clip about 6% off of that.
Right.
Let's mark the S&P at 1800 instead, and your NAV gets clipped for 6%. And that's how much you get for your redemption. Wait a second, that would be the biggest scandal of all time. People would be going crazy. But since that happened to silver and silver miners and silver producers, nobody cares.
Nobody cares.
Remarkable.
It is remarkable. I mean, and the thing is that it's money. I mean, it's actual money, and nobody cares. Silver and gold, they're money. Period. End of statement. Don't care what anybody says. Never convinced me otherwise. Silver's been money longer than gold, and why there isn't an absolute stampede, across CNBC or and CNN and all of them, Bloomberg, all of them should be reporting on it, but they're not. Like you said, why? Because they don't care.
That's right.
They don't get it.
And my best advice is to do what I did yesterday. When I saw it all happen, I just went out and got drunk.
Well, okay, I guess that's one way of doing it. Well, and on that note, Craig, I want to change gears real quick, and I don't want to take up too much more of your time, but I do want to bring back on September the 1st of 2015, you wrote an outstanding article called "A Death Candle for the S&P 500," and you just mentioned we're talking about the S&P 500,
Yep.
and in this article, you clearly show a 25-year pattern that where the S&P breaks down, falls apart, and it drops by anywhere from right around 50% and as much as about 57%. And that's happened on two different occasions in the last 25 years. And when you wrote this article, this death candle had just shown up, and now we see the market in the beginning of the year. This is the January's been the worst month of all months in the history of the Dow Jones. And with everything that's happened, what do you see at this point as far as how this death candle is aligning with history and with where we are today?
Okay, Rory. Now, I'm going to be real serious here for a second. As you know, I like to joke around, and when you
Yeah,
follow gold and silver on a daily basis, if you don't joke around with it, I mean, you'll make yourself suicidal.
exactly.
Okay.
So
But
let's be
now, but
serious.
now, for everybody listening to us, yeah, they may own some gold and silver. They may own a lot of gold and silver, but it's a pretty good chance they own some stocks, right?
Right.
Whether they are in a self-directed IRA, whether they've got a 401k at their work, whatever. And the last absolute smash in price, bear market, whatever you want to call it, was back during the financial crisis. And that's where we all got familiar with the old joke about the 401k becoming the 201k, right?
Yes.
All right. Well, I want to lay some numbers out, and sometimes it's really hard for people to follow along with numbers when they give them to you with audio. So I just want to plead with anybody listening to listen real closely, back up and play it again so this all sinks in, because this is pretty strange how this is all working out, and scary at the same time. I would also add, and every time I've written about this all comes with a caveat. The market crashes of 2001 and 2008 all took place in an environment where we still had some semblance of an actual, and I'm using air quotes with my fingers here, market. We don't have a market anymore. Market is a scam, a sham, an illusion of high frequency trading computers swapping everything back and forth amongst themselves. 80% of the volume on the New York Stock Exchange is high frequency trading computers. There was just a report said more than 50% now of the volume on the Tokyo Stock Exchange, also high frequency trading. Okay, so this idea that there's a market of stocks where people are recognizing value and putting some money into low P, I mean, it's all a scam. Nothing of the sort. Stock market's up today significantly, and you'll read all kinds of stuff about investors return to the market today looking for bargains after the January sell-off, and so that's all garbage. 100% BS.
Yep.
The stock market's up today because overnight, the Bank of Japan initiated a negative interest rate policy. This has caused the yen to fall sharply today, as much as 3%. The falling yen is seen, if you will, by these high frequency trading computers, and they use that as impetus to buy S&P futures. You can plot this on a chart. They are 100% correlated, 1-to-1, up and down, up and down, up and down. Any changes in the yen affects changes in the S&P directly. Okay, so that's the only reason the stock market's up today. So let's get that straight. Now, that said, it's easy to affect the yen, as the Bank of Japan did overnight, which means it's easy to affect the stock market. So the caveat is, unlike 2001 and 2008, we've got the central banks of the world, the Fed, the Bank of Japan, the Swiss National Bank, the ECB, all on really almost a daily basis in directly impacting, you could say manipulating, managing, whatever, to try to keep the stock market up. Okay? So you with me so far?
With you right there.
So everybody needs to know that though I'm about to give you some really scary numbers, this could all be dead wrong, because the central banks are in there trying to create this imaginary world on a daily basis, and maybe they'll be successful. It could very well be. But here's where it starts. Back in August, I had pulled up a 25-year monthly chart of the S&P. And the reason we call it a death candle is because one way you look at these charts is by using what we call candlestick charts, okay? That show the whole range of whatever you're measuring on a daily, weekly, monthly basis. And I noticed in looking at that chart in August, this was before the market started to melt down, I noticed that, God, it sure looked like we were rolling over again, just as we had in 2001 and 2008. And I noticed that the key to that rollover was breaking the uptrend. That's what had to happen first. And in December of 2000, there was a big, ugly red candle, a death candle, breaking the uptrend to the bull market that started in 1995. In January 2008, there was a big, ugly red death candle that broke the bull market that went from 2003 through 2007. And I thought, man, we get one of those death candles here in August, we'll be following the same pattern. And lo and behold, that's exactly what happened. Everybody remember the stock market really. There was that day, August 24th, when we would have opened down 3,000 points if it weren't for the circuit breakers. Remember that?
Exactly.
Okay, so here's where the similarities begin. That death candle marking the end of that bull market from the late 90s, the range in the S&P that month was about 10%. The total final loss for the month was 5%. The death candle that marked the end of the next bull market in January 2008, preceding the financial crisis, the range was 14%, and the final loss was 6.5%. The range in August of 2015, this latest death candle, the range was 12%, and the final loss was 6.7%. Sound kind of eerily coincident, Rory?
Yeah, it sounds like a pattern.
Okay, so then here's what happened next. And I wrote this, I don't know, in September or in October. I said, okay, if this pattern's going to continue, after those two previous death candles, we had what we call a green candle of hope. When all of a sudden the market magically recovers and everybody's full of hope because, don't pay attention to what just happened. No. The trend continues, the bull market, yay, everything's going to keep going.
We're saved.
Exactly. The green candle of hope that followed the death candle in January 2000, the green candle of hope was in January 2001, and the S&P rallied 10%. In the spring of 2008, following the death candle of January 2008, the S&P rallied 14.6%. And this last fall, following the death candle of August, the S&P rallied 12%. Sounding familiar again, Rory?
Wow, that's incredible.
Okay. So then we wrote again, back in December. I can't remember. It was the first of this. I think it was in December, wasn't
Yes,
it? Okay.
it
And said, okay, now we're 2 for 2 here. We got to find one more thing. What's going to be the key indicator that has happened in the past that maybe slammed the door shut, pounded the final nail in the coffin, whatever metaphor you want to use. And I went back and looked. And if you pull up that monthly chart of the S&P and you lay on there a couple of moving averages, which is a 6-month moving average is just the last 6 months of monthly closes. A 6-month monthly moving average is the last 6 months of monthly closes for the S&P. You get a new month, you throw the old month out, and you get this rolling number. Okay?
Right.
It's a key technical indicator. A lot of market technicians, technical analysts follow moving averages. A lot of computers are built to follow it, that kind of thing. Okay. I went back and looked at that same chart, that same monthly chart for the last 25 years. And I found here was the final straw. Here was the final nail in the coffin. If you take a 6-month moving average and you watch it roll over, break down, and bearishly cross downward through the 24-month. Okay. When that happened in 2001, that was it. We'd had the death candle, we had the green candle rally, but then the market rolled over again. Those two lines crossed, that 6-month moving average crossed down through the 24-month, and it was over. And the total collapse, once it really got going, from where it had peaked out to the low, was something like 49% in 2001. That was a dot-com bubble.
Yep.
2008, same thing happened. That 6-month crossed down through the 24-month. That was all she wrote. The ultimate collapse was again about 51%, I believe. Again, that was your financial crisis, real estate bubble. That was your 401k becoming your 201k.
Yeah, it was 56% actually.
Is that what it was? Okay.
56.86 is what you
All
got.
right. Well, we've been watching those moving averages all month. Today, Friday the 29th, is the last trading day of January. So we will have the official numbers here as we speak in about an hour. The S&P 500, as I look right this instant, is 1928. If it closes below, that's right about 1920, which makes today's rally certainly good timing. But if it closes today below 1920, on the monthly chart, the 6-month moving average will have once again crossed downward and through the 24-month.
Oh,
So, everybody listening, if it's now the weekend or whatever, pull up the S&P and see where it closed. If it closed above 1920, well, for now, we dodged a bullet. We'll see what February brings.
yeah.
But if it closes below 1920, then we will have ended the month with the 6-month below the 24-month. That's the last piece of the puzzle. Another 50% correction in the S&P would ultimately bottom it out somewhere around 1,100. It'd bottom the Dow out down around 9,000. Okay, so that's what I mean. It's time to be serious. If you got money in the market, you got money in a 401k, you cannot afford to get yourself wiped out again, right? Especially if you're closing in on retirement. This is not a time to be sitting there listening to the cheerleaders on CNBC and Bloomberg, hoping for the best. Now is the time to actually plan for the worst. Be very cautious, be very careful. And if you see the S&P moving down again, it's probably time to be wise to reconsider your allocation to stocks.
Now, the question that I have, Craig, is can the market, which means human beings, actually overrun the other market known as the high frequency trading computer?
Yes, that's what you wonder. Because again, you say, the stock market's manipulated by the central banks, and people look at you and go, yeah, right. I mean, that would take the conventional argument is how many trillions of dollars they have to print to buy enough shares of Apple, enough shares of IBM, enough shares of ExxonMobil. No, that's not how it works, man.
Not how it works.
These machines do all the heavy lifting for them, the high frequency trading machines that control at least 80% of the market. If you can affect the inputs that these machines follow, most importantly, that dollar yen, if you can move the yen, you can make the machines do the dirty work for you. And that's what we get when they do what they did overnight at the Bank of Japan, and now all of a sudden the stock market's up 300 points today, okay? So to your question, can it be avoided? I don't know. We'll see. Here's the thing I've been paying really, really close attention to, and this would be another thing for people to watch. Deutsche Bank, which is one of the top 2 or 3 largest banks in the world. Okay.
Yep.
They have an American depository receipt that trades over here on the New York Stock Exchange. And as we speak, it's trading at about a little under $18. That doesn't sound too ominous now, does it? Unless I tell you that within the last year, it was trading at $36. Or in the last 6 months, it was trading at $30. And if you pull up a chart on Deutsche Bank, it is going straight down, lower than it has been the entire 19 years that it's been traded here in the U.S., lower than it was in 2008. Now, why is Deutsche Bank going down? Well, that's a good question. From what I understand, from the people I talk to, they are the bag man, if you will, not only in derivatives, but specifically commodity derivatives. And most folks know commodities are all in the toilet, from crude oil to copper to base metals to everything. And all these derivatives that were written on commodities, it appears that Deutsche Bank may be the bag holder for them, much as AIG was the bag holder for credit default swaps back in 2008. And AIG went from this AAA rated insurer, triple digit stock price to nothing.
Yep.
Well, that's what I'm hearing and fearing about Deutsche Bank. And again, pull up a chart, you see it for yourself. Now, if Deutsche Bank, if I'm right, and this all continues, what if Deutsche Bank goes to 0 or 1? They're totally insolvent. That's the kind of thing that could not only in a daisy chain linking of, derivatives and counterparty risk, bring, the banking system to its knees again. That's the kind of thing that could overwhelm even the most nefarious chart painting intentions of the central banks. Watch, everybody, please watch Deutsche Bank closely. Symbol DB for douchebag. I'm sorry, Roy.
Oh, that's good. I like
It's
it.
gotten way too serious for me.
Oh, it's
No, please,
well.
everybody,
I mean, but this.
watch Deutsche Bank very closely. Go to you pull up a charting service on the internet and just type in the symbol and look at what has happened to it, even just since the first of the year. Um, people say, there's nothing like 2008. There's no bubble. There's no really. Okay,
Really?
well, maybe you're just not looking in the right place for that bubble that you seek. And keep an eye on Deutsche Bank, and then, like I said, keep an eye on that S&P. If it breaks down again, we may dodge the bullet here in January, but if it breaks down again in February, it could very well be foreshadowing a significant drop here in 2016.
So everybody needs to heed the warning, and that's all that
Yes.
it is a
Yep.
warning. Is just pay attention, be vigilant with your wealth, because believe me, these criminals, then three of which we identified earlier, HSBC, JP Morgan Chase, and UBS, they're out for themselves. They're out for your wealth, period. They want it. They don't want you to have it. They want them to have it.
Yeah.
So, a word to the wise. I mean, I got out of the stock market a long time ago. I have no vested interest in it whatsoever, and I could care less. I mean, the only reason that I care is because I know the implications and the impact that it will have on everyday life
Yep.
for my neighbors, my family, and my friends, and for everybody listening. I understand that. And that's the only reason that I care about it, is because of all of you guys. And otherwise, it would just be, just another rigged market that is just like, well, okay, whatever. But
Mm-hmm.
it's a little bit bigger than that. So, but anyway, we've been speaking with Craig Hemke, who is the president of Turdville over at tfmetalsreport.com. Craig, why don't you tell them about what you got going on over there?
Roy, this site now is over 5 years old, which I don't believe until I look in the mirror and see all the lines on my face and the gray on my head. And then I realize, yeah, I've been following this crazy stuff for 5 some odd years. It's a wonderful site. It's packed full of people that we all see what's coming, and we're all here to try to help each other.
Exactly.
I offer a subscription service where we try to monitor price closely on a daily basis. It's a whopping $10 a month. I think there's reasonably good value there, and I encourage everybody to check it out. tfmetalsreport.com.
And I would agree that it's an exceptional value. Had a subscription for close to a year now, and it's unbelievable what you have on the paid side. It's really remarkable, and
Well, thank you.
the community. And just a reminder, Craig, I've been following you since you had the old site, before you went to the new one,
Right.
and that's where I first began following your work, and man, the changes that we've seen.
It has been something else, and you've got the same lines and gray hair that I do, my friend.
Unfortunately.
So, well, hang in
Yes, I
there.
do. Well, Craig, I'm not going to take up any more of your time, and I certainly appreciate all that you do, and we will talk with you soon.
All right, all the best, my friend. Keep the faith.
Thank you.